Hello everybody. So in this video, I want to cover stocks that are relatively cheap compared to either their sectors, their peers, their competitor, or either compared to what they used to trade at. And so I see 4 deals in the market respective of their own sector. It's Applovin, SEZL, which is a buy now, pay later company that's firing on all cylinders, IREN, which is kind of the Nebius counterpart, also aiming 5 gigawatt of developed capacity for their neocloud business, but, kind of left behind. And then Meta, which is a Mac 7, which is now much cheaper than all of the other Mac 7 and continues to be cheap. Meta cannot catch a bid. So anyways, let's get started with Applovin. I've covered twice in the past 2 weeks Applovin. Applovin is down because the growth didn't go up as fast as they thought it would. They are working on their AI development with the Axon platform, as they call it, and the algo improvement that they hoped to have for this quarter didn't really work as well as they used to, and so it's a temporary deceleration. They're already working on improving again their efficiency in their sales, and the stock has just dumped entirely. If you look at the stock, it's down 50% from 2 months ago. It's down 50% from a year ago. It hasn't done much in more than 2 years for a stock that really used to be the darling of Wall Street, at least ever since 2024. This stock was the high flyer of Wall Street, the darling. In fact, if you look at the total return since IPO of Applovin, we are at 33% annualized every year, 33% return versus 15% for the NASDAQ over the same period. And so to me, this stock relatively right now is very much underperforming. It may look a little expensive on EV over GP over RG, but the main reason for that is because the price to sales, right, the multiple of the stock is a little high. Why is it so high? Because of their EBITDA margin. Their EBITDA margin is 79%. That is not a typo. That is not a mistake. This stock is pretty much pure margin, and so it attracts kind of a traditional type of investor as well as the growth investor. This is a stock because of its margin. This is a stock that can attract a value investor because of how much money they are generating and making. And this stock really has a tremendous avenue for growth. Much of their success right now has been from being the leading publisher of ads on games on phones, right? Pretty addictive games. You want to play another round. You want to get some points in the game. You have to watch a 30-second ad. The leader in that space is Applovin, and they're especially the leader on iPhone. On Android, they're in the top 2 publishers, right? Because Google is the number 1 on Android because they own Android. But the point is, they use their platform historically to promote more games, to promote new games, to sell to gamers other games for them to install. They're shifting that. Now they are selling to gamers consumer goods, consumer products, all sorts of e-commerce, retail. They're moving into that type of advertising to their billion-plus installed user base that uses their game on a regular basis. And as a result of that, I believe Applovin has a tremendous avenue for growth. And to me, when I see such a drop in no time, I mean, not that it's odd in 2026, right? How many stocks are down 50% right now from like months ago or a year ago? A lot of stocks are like that. But still, it's still a major drop. And I don't understand it. And, the analysts got a little messy and they downgraded the stock. Okay, but I don't think that's going to hold. I mean, if I look at this stock, it's been having a hard time to rebound. But in my view, in the advertising space, this this is the winner in the advertising space, much more than, say, a trade desk, for example, which keeps getting into a valley of despair, getting its lunch taken by some new players. And I think Applovin is one of those players. Anyways, let's talk about Sezzle. So Sezzle is one of the stocks that has surprised Wall Street, and for good reason. If you look at Sezzle since IPO, this has got to be one of the best IPOs ever, at least of that era. Remember how many IPOs crashed in that era? That wasn't the case for Sezzle. Sezzle returned a 44 times your money if you had gotten it at IPO. The average annual total return, average return every year, 260%. So just blowing past the Nasdaq like it's not even funny. And Sezzle, same thing, went way down. And I really don't see why it went way down. I mean, they're moving to subscription. They're pushing their subscription. I listened to the call. To me, everything's doing just fine. I guess they disappointed the analyst a little bit by just a percentage point or something like that on one of the metrics, but really not that big of a problem in my view. Sezzle, I think, keeps winning. It's the super fast, the smaller BNPL player in the US. It's the super fast growing one. It's the one that definitely has the best total return ever since they went to the IPO. And they have competitors. There's namely two big competitors. I don't have Afterpay in there because Afterpay is part of Cash App and part of Square, so we can't really analyze Afterpay on its own. But really, there's three players. You have Sezzle, you have Affirm, and then you have Klarna. And so Sezzle really distinguishes itself by being the fastest growing one as well as the most profitable one. And so that's why the EV over GP over RG for Sezzle is 0.24. It's cheap again. A while back, it was expensive. No, now it's back into the cheap. The rule of 40 is 101. That's way more than all of the competition. And then you have Affirm. So Affirm, I have a hard time understanding why it's so expensive. Yes, Affirm is the established player. It's the most well-known player in the space. It's the biggest player in the space. It's kind of a blue chip in the space, and so it has this premium valuation. I don't really know why. And then the last question mark in the space is, of course, Klarna. So the reason why Klarna is not doing too well and why it's down, per my understanding, is because they are very exposed to Germany, and there's quite a bit of issues in the German market. I also saw perhaps they may be having some tough growth in the US. I saw some somewhat negative PR on Klarna in the US. Klarna is definitely trading at a discount. I think Klarna is more of a turnaround story. It would require a little more attention. The problem with Klarna, and they highlighted that on their call, I think it was their November call of last year. One of their problem is they have to educate the market on how they compute profitability at Klarna. And, I'm generous. I put 1% in EBITDA margin, but it's actually slightly under 0% on the EBITDA margin. So that's also one of the problems. It doesn't catch a bit because the market seems to have issues calculating the profitability or disagrees with the way they report profitability at Klarna. So Klarna to me is the turnaround play, Affirm is the blue chip, and then Sezzle is the growth play, now at a discount, now down 33% from prior to their Q2 earnings. So I think Sezzle relatively is a good deal here. Then moving on to IREN. Been talking about IREN a lot these past 2 weeks, even though I hadn't talked about it in years because, I had, and it was a mistake, but I had dismissed IREN back in the day because they were selling all of their Bitcoin. Clearly, IREN was already thinking about something else. IREN is now a neocloud with contracts and with ARR, recurring revenue, and with a ramp for their revenue. And so as a result of that, as a result of IREN having insignificant mining, the mining operations are now not significant for IREN, I can actually put IREN in a spreadsheet and entirely compare it to the two other players, the two other neoclouds, which are Nebius and CoreWeave. Really briefly, the difference between a neocloud and a colocation play like a Cypher, for example, is that the neocloud buy their GPUs, they own the GPUs, they're vertically integrated and they own the GPUs. A lot of Bitcoin miners who are moving into HPC decide often to not own the GPUs, but to provide a shell. They provide a building with cooling, with electricity, but they don't want to own the GPUs. That's the main difference between these three and the other ones. And when I fully analyzed it from the channel, that was a few days ago here, I actually said that the stock was almost 5x cheaper than Nebius. Now, ever since that video, Nebius dropped quite a bit, right? It dropped into the 220, 215, and then IREN stayed flat, which means that the valuation gap has now narrowed. And if you look at the trailing 12-month valuation, you know, it's between 3.5 and 4x, right? It's not 5x cheaper anymore, but it's still about 4x to 3.5x cheaper, depending on intraday where you look. And I still can't explain that. I still can't explain why IREN is that much cheaper. Yes, I believe that if both Nebius and IREN were the same valuation, I would prefer Nebius. But when I look at the trailing 12 months, to me, there's still a valuation disconnect between the two. Perhaps the market is placing a premium on Nebius because of prior returns. If you look at prior returns, Nebius has absolutely outperformed IREN, 269%. But you see, it's not even 2 years, right? But it's clearly outperformed it over IREN. I think Nebius maybe getting a little bit ahead of themselves. There was some shorts squeezing, shorts having to cover, having to buy back the shares. I've been very happy with the performance of Nebius. As you know, back in the day, I had chosen Nebius. I had invested in Nebius. I'm very happy with the 10x in Nebius. I just think it ran too far, too fast. And these assets sometimes tend to mean revert. And IREN has just been waiting for its turn. So in my view, when I look at IREN, I find it too cheap relative to Nebius. And when I look at my spreadsheet, EV over GP over RG, you can see IREN is a 0.1, Nebius is a 0.14. And so that's a 40% discount on a forward growth basis. And then we have CoreWeave, but CoreWeave is kind of a special situation. The stock is the biggest in the sector. It's tougher to move the needle. And CoreWeave, you have a lot of FUD. You have a lot of people who dislike the debt at CoreWeave, and they'll make no mistake, whether it's Nebius or IREN, they will add debt to their balance sheet as well. But these free plays, out of these free plays, to me the cheapest is IREN. And let me conclude to talk about Meta, to finish with Meta. So Meta is the cheapest Max 7. I mean, there's no other way to put it. It's the cheapest Max 7. It's trading at a valuation of 0.33. The Rule of 40 is a 71. So highly profitable company, in line with Microsoft, really, as far as profitability goes. Growing fast, 23%, right? Growing faster than most of the Max 7. Of course, except NVIDIA. NVIDIA is the one that grows the fastest. But if you look at valuation 0.33, I mean, we're not too far from companies that are arguably way less solid than a Meta, right? If you look at Sezzle's valuation as 0.24, or Affirm as 0.54, or even Applovin as 0.57. See, Applovin is a good example. I mean, who's the best in the advertising space? Is it Meta or is it Applovin? One of them is a top 7 company in the world. The other one is not there yet. So I don't understand why it's so cheap. The market, of course, there's two things really that the market doesn't like about Meta. First of all, is the capex. And it got me thinking, I think the market forgot about this part of the capex. You may remember that Meta has actually a long-term purchasing plan with AMD, which will give them an option to own up to 10% of AMD in a matter of a few years. And I think that's a very big deal. If you have Meta that matures at one point, they would be able to own 10% of AMD through a deal that they signed for purchasing their systems and purchasing the AMD system. OpenAI having a similar deal. I think this is a very, very big deal that they could own AMD, especially own 10% of AMD, especially as AMD is picking up steam in the market. I think people have forgotten about that. But of course, the main reason why Meta is down is the California lawsuit with that headline number of 1.4 trillion, which is a headline number to get the clicks, to make people scared, essentially. But that number is the max number that they put on there. These numbers, assuming Meta was to be found guilty, these numbers always get renegotiated way down. But unfortunately, as long as this suit is going on, I think we're going to have a bit of overhang on the stock. And that's why the stock is down. And it's disappointing to see it under 550. Now, is that going to last? I just think we need the headlines on this California suit. We need those headlines to go away. Historically, I see these headlines go away about 10 days after they come out. So maybe next week, maybe the week after next week. I haven't seen anything really that bad in these headlines. It's just always the same headline being recycled for clicks. That's the main explanation as to why I think Meta is down. Over the long run, it's the leading app. I mean, 3.6 billion people log into one of their apps every day. 3.6 billion. Think about that. They own Instagram. That's the leading social media. They're able to launch other social medias through their family of apps. They're able to promote social media to social media users. They really took the turn of TikTok, and now they have viral videos just like on TikTok. To me, it's a highly competitive company, and they will try to push consumer AI. Are we gonna be in a world where hundreds of millions of people at some point maybe pay $249 or $299 a month to have Instagram Plus or WhatsApp Plus? Is that something that's going to happen? I think that's the vision that Mark Zuckerberg has for buying all of this AI. And they bought all of this AI, for some of it years ago, for other part of it last year, when the prices were much lower than they are today. I mean, we saw NVIDIA announce an increase in the cost of AI servers by 15% today. It was not NVIDIA who announced it, it was reported. But if NVIDIA is raising its prices, if everybody's raising its prices, here you have Meta, a company that has contracts already signed. The value of compute is actually going up. And so maybe Meta can turn around and resell some of that compute if for some reason their use of those GPUs doesn't manifest itself. They don't need the GPUs for some reason. They could resell the compute. But I think they will use all the GPUs that they got. But anyways, quite cheap in my view, much cheaper than the other Max 7s. So anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.